Hello everyone, I'm Kunal Sodhani from Global Trading Center, Shinhan Bank, India, and we are here once again to understand what's happening in the currency market, understanding and breaking down into global and domestic factors. So speaking first about the domestic factors, let's understand what's happening with the FPI flows. The FPI flows for equities for the month of May has been negative to the tune of 28,000 crores. While if we talk about debt, it's been flattish, positive 178 crores. So we can say as flattish at this point in time. But overall, if we talk about the year 2024, we have seen equity flows to be negative to the tune of 26,000 crores on a net basis. While if we talk about the debt flows, they have been quite tremendous to the tune of 45,000 crores. So net in overall terms, we are still positive because of the debt inflows. If we talk about the FX reserves, we have seen a raise by $2.5 billion, and now the FX reserves are standing at $644.5 billion roughly, uh, thanks to the FCA, which has been rising, and also the gold reserves have been rising. Overall, we are standing near the all-time highs of around $648 billion, and also we are at a 11-month import cover, which is a decent position as per the FX reserves is concerned. The CPI print, which we saw last time, we have already discussed about it. That was softer, but then again, the food inflation remains sticky because the vegetable inflation still has risen by 27%. So that's from the domestic perspective, but elections is something we cannot miss because the polling has been done for 5 phases. And if we talk about the fifth phase, the voter turnout was around 57%. But Maharashtra being one of the major contributors, the voter turnout was only 49%. So obviously the low voter turnout remains crucial because it creates difficulties in terms of gauging the right exit polls and the number of seats which a party may win, which in turn obviously can create some volatility in the financial market before the actual results come out. But on the contrary, if we talk about the global factors, particularly what's happening with the Fed, we are seeing some kind of divergence between the data points and between what the Fed speakers have been saying. So if we talk about the data points, we did see a softer CPI inflation and other data points also were softer, which on the contrary, if we talk about the Fed speakers, they continue to be hawkish that no, it still may take time in terms of aggressive rate cuts. The data is suggesting that we will still have 3 rate cuts for the year. If we talk about a CME market tool, they're discounting 76% of the probability of a rate cut by quarter basis point in September, followed by two more. But if we go by the tone of what the Fed is saying, it doesn't seem so that 3 rate cuts will be seen for the year. Personally, if you ask me, I am eyeing maybe one or maximum 2 rate cuts for the year. On the contrary, if we talk about the ECB, they have been dovish. Their stance have been clear that they are eyeing June to be a month where we can see a rate cut from the ECB's perspective. While on the Bank of England side, they seem to be delaying it, maybe, or they may be in sync with the Fed. So overall, this trajectory of hawkishness and divergence between economies and within economies are also continuing, which makes it difficult to gauge, how the dollar index may pan out. But currently, we feel that 104.10 acts as a very immediate important support level for dollar index from where it has recently bounced, while 105.60 acts as a major resistance. In case only if breaken the all-time highs, which was the near all-time highs, I could say, of 106.5 or 106.52 to be precise, can be tested. For dollar rupee, we expect 83.20 acting as an important support, while 83.55 continuing to act as a major resistance. So that's all from my side, friends. Thank you so much and wishing you all a very happy trading session ahead. Thank you.